going to see as well is like at the end of the presentation is like portfolios of users who are using exponential today or DeFi yield today to make interesting returns. Obviously, the most important part as well is not to get rugged. And so we are going to look into how we assess risk in DeFi and how you can do your own research to make sure not to get rugged. Obviously, I would like this presentation to be as interactive as possible. So don't hesitate to ask questions and I will do my best to answer them either during the presentation or at the end. All right, let's get started. In terms of the agenda today, we're going to look into where does the yield come from, and that's basically a yield overview of in DeFi. We are going to see how the yield is and how to get like the best ones and how you can use exponential to do that. We're also going to look into the risk assessment. We're going to deep dive into the yield opportunities and look into specific portfolios. All right. So here is the DeFi yield landscape today. 4.6% is what is the return in terms of a yearly basis that people are making on average or as a median on DeFi. But that is different depending on the asset that you're investing with. So this, just as you would have a different yield or risk-free rate in the US dollar or on the yen or the euro, you have actually a different yield on Bitcoin, Ethereum, and stablecoins. So on Bitcoin, the yield is pretty low, around 1% in the median. And the reason for that is that there are very few yield investment opportunities for Bitcoin. We expect that with new Bitcoin layer 2s, there will be like more opportunities to arise. But today, there is mostly a few jobs on lending for people who want to short Bitcoin, which is very hard. And basically, the supply of Bitcoin is overcrowded in a sense. Then we look into Ethereum. Ethereum has a natural inflation that is related to staking, to proof of stake, and that is around that 3.7%. And so most of the yield in Ethereum is based on that liquid staking. We will look into more attractive opportunities that you can see both on exponential and outside in the DeFi world. And finally, the highest yield is actually on stablecoins these days. And the reason for that is that a lot of people want to go leverage long on either Bitcoin or Ethereum. And so they're using stablecoin to get that long exposure. And so on a bull cycle like the one that we are living today, you would end up having higher stablecoin yields. And so we see around 6%. Now, during this presentation, my objective is to get you like double or triple of that in terms of exposure by looking at returns exceeding 4% per year on Bitcoin, 8% on Ethereum, or even more, and 12% on stablecoins. Let's look into it. Just before we get into like all of the yield opportunities, I wanted to touch base on where does the yield come from. And so there are like four big sustainable jobs that allow us to get yield on DeFi. The first one is secured lending, and it's basically like lending dollars or to users who want to go, for example, leverage long, and so they need those dollars. They put Bitcoin as collateral, for example, or Ethereum as collateral, and they get the chance to get the dollars that you provide them, and you get an interest on that lending. The other job that is available is market making, where you basically act like the person at the airport that on the currency exchange that exchanges two currencies, one for the other. And so you get the commissions on every trade that is being done. Bridging is a similar one. it's basically allowing value to move across chains. And so you get commissions by moving value from one chain to another. And finally, staking is about basically verifying transactions with proof of stake chains. And so you are making money just like a notary by validating the right transactions. The interesting part here is to be able to look more into this. So we built a handbook for DeFi newbies to get started into understanding where the yield comes from. And it's basically on this one. This is the book. So I recommend like downloading with that QR code, this book, the handbook on where does the yield come from, and you will be able to see all of that and read it easily at home. As an overview, this chart allows us to see the different jobs, and we see that like over the past 3 quarters, staking has become like something that is very important. And interestingly enough, at the end of 2023 is also the time where Coinbase and Kraken were offering staking. And so staking became like a really important source of yield and TVL. We also see over the past 2 quarters that lending became something important. And this is related to the fact that the market is becoming more and more bullish. And so there is a lot of need for stable coins in order to go leverage long on Ethereum and Bitcoin. We see that there are also like other jobs. Market making, for example, has decreased over time since 2023. And that's mostly related to the fact that it's becoming a job that is more and more concentrated with concentrated liquidity on Uniswap v3. So that, for example, is a job that needs less and less liquidity to be done on decentralized finance. There is also here what you see bridging. Bridging is, there is very little liquidity or need for bridging here, but we will look into two interesting opportunities to provide liquidity to bridges on chain. And in terms of derivatives and insurance, these are two jobs that we think are not necessarily easy to do in DeFi. The main one in terms of insurance, we think that, for example, insurance creates an asymmetry of risk. And due to an asymmetry of information to start with, where as lenders and as retail lenders, we don't have all the information to invest and provide liquidity to insurance. And so it doesn't really make sense to have this in DeFi. All right, we added this little QR code here for people who are interested in looking into the State of DeFi report, which is a report that we publish on a quarterly basis, where we look into all the yield opportunities in DeFi and the DeFi market overall. So you can scan it if you'd like. All right, the most interesting part, how to assess risk in DeFi. Assessing risk in DeFi is actually pretty hard. And so we have tried to make it as easy as possible. The background is that over the past few years, risk management in DeFi has moved to the forefront of the priorities. And that's why we developed a risk rating system to help you quickly assess the risks associated with each investment opportunity. As a matter of background, I started my career in finance. I have worked on distressed assets at Credit Suisse in London during the financial crisis of 2008 to 2012. And then I moved to Nairobi to work at the World Bank and invest in frontier markets in sub-Saharan Africa. And so through these experiences, I learned how vital understanding and managing risk is. And I was able to work with everyone at Exponential to build this risk rating. So let's look into it. So risk rating is pretty hard, but what our job is to basically rate the risk of every yield opportunity. So the counterpart of yield is basically risk. And so we developed a detailed risk rating framework to give you a holistic view of risk in DeFi. So each pool or protocol is evaluated across several factors, and you can see them here in the middle. But where do we start? We start with actually the DeFi graph, which is what you see on the left. If you are investing in Yearn, ETH market making pool, you may think that you have exposure to Yearn as a protocol, but because of the composability of DeFi, Yearn protocol is actually based on another pool in Curve. So what we say here is that you basically have exposure to Yearn, but also to Curve in terms of risk. And let's assume that you are on this pool that is market making between ETH and STETH, which is another form of ETH. Well, you do have exposure to these two assets. And STETH is only as strong as the protocol behind it, which is Lido, that is allowing the creation of STETH. And so what we do is that we build a DeFi graph that is looking into all the interdependencies on DeFi, and we compound the risk of Lido, STETH, ETH, Curve, Yearn, and the chain, Ethereum, to get to a risk rating for the pool. So this is very important. The way we do it is by looking into, we have defined a scorecard for every asset, every protocol, and every blockchain. And that scorecard is the same for all these three elements. It's a set of questions that we answer with public information. For example, to assess the protocol code quality, we're going to look into the track record of the audits. Are the auditors themselves reputable auditors? So we have like almost like an assessment of the auditors as well. Has the protocol been around for a long time? Has it been battle tested? And so these things we help us basically assess the risk on a pool, just as an insurance company would assess the risk on an investment. And this, we put all of this into what we call the risk engine, and it gives us a probability of risk on every one of these pools, and that allows us to say, well, this is an A, a B, a C, a D, or an F. The way we look into this is that A is best in class in DeFi, and that's the Uniswap and Aave of the world. It's typically code that is fully decentralized. It's the gold standard of DeFi. B is generally because there is like one risk that we have identified and that we think that should not be there. C is the average of the investment opportunities in DeFi. And D is for basically the degens. It's for cases where we see that there is risk, that some people would want to take it, but that there is probably too many vectors of attack. And F is mostly for failed cases where we think this should not exist. Looking into risk is allowing us now to look into like specific yield opportunities. And so this is the fun part. All right. It's the fun part because this is the first time where you're going to be able to see a chart like this one. So for those who know finance well, this is the chart where you see the risk and the reward of various investment opportunities. So typically in finance, we like to put the risk in the x-axis and the reward in the y-axis and plot all the shares or all the investment opportunities in order to see the efficient frontier. Here for Bitcoin specifically, we don't see any frontier. We see like that some investments are better than others. And so it would be very interesting to understand what across WBTC and Curve eBTC, TBTC are in order to see these investment opportunities. The thing that is absolutely interesting with Bitcoin yield is that a lot of the yield is at zero. A lot of TVL is around that zero. So typically what happens is that there is like a very high supply of Bitcoin that is looking for yield, and it brings down the yield, because as the pool gets heavier in TVL, so as the size of these bubbles gets bigger, you end up like having less and less yield. This is related to the fact that the more capital is available to get some yield, the lower the yield, because you basically have a lower utilization of that capital to generate the same amount of like jobs. So let's look into one case. This is an interesting case, Curve BTC market making between eBTC and TBTC. So that may sound a little bit complicated for the DeFi newbies, but in this case, you would be market making between two forms of Bitcoin. The first one is eBTC and the second one is TBTC. So this is interesting for the DeFi pros, because there is a lot of discussions nowadays about the fact that WBTC has been taken over by Justin Sun, and that there is heightened risk there as it's moving away from like the golden BitGo level of custody. In this case, you are able to make about 4% yield on two Bitcoin assets that are a little bit different from the WBTC. TBTC is a fully backed, decentralized Bitcoin on Ethereum. And eBTC is an over-collateralized form of Bitcoin on Ethereum as well. And so in here, you would be providing liquidity on the protocol Curve, which is a market-making protocol or a decentralized exchange. And every time that someone is swapping eBTC for TBTC, you would be earning commissions. And so this is the typical type of information that you would see on our website. And the amazing part is that this whole information is publicly available to anyone. You would just go to the pool page on the website, and you will be able to see all of this. There is this risk details section that is particularly interesting, where you see that everything from pool design to asset tokenomics to protocol and chain design and maturity are green. The only thing here is that there is some risk compounding because you have exposure to two assets. And that's what getting us to a risk rating of C, or average. So this is an investment opportunity that I like a lot, because not only I don't get exposure to WBTC, but also I get to be able to look into get yield on Bitcoin that is 2 or almost 3 times higher than the yield that everybody has on Bitcoin today. All right, let's look into Ethereum yield. Ethereum yield is much more interesting here, in my opinion, because you kind of see the efficient frontier. It's very interesting because you have many more opportunities, and so you tend to look into that efficient frontier where the more risk you get, the higher the yield you can get. And there is like very, very few opportunities that are actually above the risk frontier. So basically that means that everybody is looking into the yield in Ethereum and trying to get the right yield. Most of the TVL is in this low risk part, where they are investing into Lidos or staking. That's basically the staking yield. But we will see that there is like interesting opportunities here, for example, with Hop ETH, is basically doing ETH bridging on an canonical basis. So it's a much more safe way to do bridging. And Yearn ETH Plus is doing market making between ETH and ETH Plus, and ETH Plus is itself a fully collateralized form of ETH that is making yield. And so these two opportunities are above the double-digit yield, and so they're really, really interesting. Let's look specifically into the reserve ETH yield. The reserve ETH yield has a name of degen ETH, and is a form of ETH that is fully collateralized. The issue here, when you look into the risk details, is that it has exposure to many protocols: Reserve, Convex, Curve, Morpho, and Dinero protocol. All these protocols, however, are actually very well rated. It's just the compounding of all these protocols that makes it high risk in our risk framework. And that's actually like true that more, as you have more exposure to many protocols, you end up with more risk. But we end up with like, nevertheless, a double-digit yield that is very, very interesting. And so for me, because I already like have exposure to Reserve and Convex and Curve and Morpho across like different investments and yield opportunities, I'm very happy to get this 16%. Finally, the third part, let's look into stablecoin yield. Stablecoin yield is actually super important because it's the closest thing to the real world, and a lot of people don't want that exposure to Bitcoin and crypto and Ethereum. And so this is where we can show DeFi compared to TradFi. And it's pretty good. When you look into the yield, there is like a lot of investment opportunities that are making more than 10% yield on a yearly basis. And so let's look into one of these. Across USD bridging. This one is basically allowing people to move DAI, which is like one of the most used decentralized version of a stable coin, a dollar stable coin. And it allows people to move those dollars from Ethereum to layer 2 chains and back. And so you would be making like returns by charging commissions. Automatically, it's done by a cross, charging commissions on the movement of these. The interesting part as well here is to see that the yield has been consistent over time on the double-digit level. And when we look at the risk, there is definitely a risk related to DAI itself. We have put recently, like about 2 months ago, we have published something around Maker DAI, because we looked into the fundamentals of DAI. And by looking deeply into how DAI is backed, we noticed that there was a lot of real world assets that we thought were bringing a little bit of risk into DAI. And so we had to downgrade DAI, although it is like the most used decentralized stablecoin today. And then in terms of the protocol itself, the protocol is actually very good. It has been around for more than 2 years. We consider it battle tested, and it is a form of bridging that is very interesting because it's canonical. So it basically takes the security level of the chains that it interacts with. So, and chain security is the highest you can imagine, much stronger than a protocol level security. All right. Any questions so far, or should we just like continue? All right, I'm just going to continue. A few tips on how you can do your research and using like all the things that we have built at Exponential. And so for noobs and like people who are really getting started, we are trying to create an environment where you can learn on your own. And so obviously that starts, I think, with this handbook, the Newbie's Guide to DeFi, but it can continue on the Learn section of the website, where we publish on a weekly basis new things for you to learn about DeFi. And I really recommend like going there. It's really a rabbit hole in the sense that the more you learn, the more things you have to learn. But it is a fun way to become to get to know more about DeFi. For more advanced investors, the ones who are considering themselves farmer, who can go and use a wallet and interact with smart contracts, we have a discover section on the website that allows you to look into the hundreds of pools and investment opportunities that we have rated, and where we bring like that knowledge, expert knowledge about the pools, about the risk, about where the yield comes from, and so on. So on that section, on a weekly basis, we get you the best risk reward pools, and you can like look into the details of these. And for those who are interested in like investing, you can invest through Exponential for some of these, or on your own with a Web3 wallet. Exponential is making DeFi more accessible also with a one-click invest. And so that's our core product. The one-click invest is basically allowing people to invest directly without thinking about bridging, without thinking about ETH gas fees, or without having to move value and so on. We take care of basically everything. We provide you with a wallet. You fund the wallet. You can fund it with your bank account as well in the US and in Europe, or you just fund it with your Coinbase or Binance if you are outside the EU or the US. And you get to invest in any type of pool that we make available. So one of them, we will look into some portfolio that the users have and the yield that they can make. But most importantly, basically, we really like looked into how to make DeFi more accessible, and it was obvious that we needed to solve the question of the UX. The design needs to be like easy, and you should be able to not think twice about custody, and be able to have a portfolio analytics that are really easy to use. Finally, for the degens, we have the search. And search is something that a lot of people love to use, because we have thousands of pools and investment opportunities on our website. And we have this really special way of like looking for these opportunities by having this proprietary information about the risk, for example, or like by being able to put together all these specific underlying assets into groups, like stablecoins for all types of stablecoins, be it like DAI or USDC or USDS, USDT. And so it's really easy to look into investment opportunities with the search function on Exponential. So this is a very easy slide for me. It's just like thinking about Exponential. Exponential is really the best, the world best DeFi yield platform. And if there is anything close to it, I would love to know about it. The way that we do things is special. We really look into security first. So we have institutional grade fund safety. Our custody systems are, I think, the best in the world. We also like think that this should be DeFi should be accessible within the framework of the regulations. We are registered in the US and under FinCEN. Obviously, all funds should be held one-to-one. Like all funds are yours. You can withdraw them anytime. And so those are like the fundamental principles in terms of safety that we start with. We also think that DeFi should be easy. And so that means like that you shouldn't have to think about gas fees. But the way that we make money is that we charge 20 basis points per trade. That's basically 4 times cheaper than Coinbase, for example. But that allows you to not even have to deal with like transferring or paying fees on chain for putting your assets to work for you on DeFi pools. So all of this has been thought through with a user first principle. One other thing is that it's very hard for people to uh, file their tax reports, and we are making it as easy as possible for the ones who need to file the tax reports by having very easy tables at the end of the year that we send you in order to be able to calculate your gains and file your taxes. The best for the end. A lot of people like to see other portfolios, and so two of our users agree to show us what they have on their app, on their Exponential app. And so this is Nancy. She's what we consider a DeFi curious. She's pretty new to DeFi, although like she has good principles in finance. Her risk appetite is conservative, so she doesn't like to take risks. And her goal is really wealth preservation, and she wants to cover her life expenses. She wants to cover her life expenses with yield, and so this is a great way to. She looks at DeFi as a great way to get returns on her assets. She's definitely a passive investor who is like playing the long-term bull market cycle, in the sense that she keeps her assets for at least 4 years in order to see a yield grow. With exponential monthly yield is $2,400. She seems happy because that covers basically what she says is that it covers her rent. And as you can tell from her asset exposure of 1/3 dollars, 1/3 Bitcoin, and 1/3 Ethereum, almost perfectly, she's basically like looking into not having to time the market. And so when we look into more details, we see that she chooses pools that are not necessarily the lowest risk, but that are still in the B category of low risk. That's the majority of her investments, 3/4 there. She likes to invest across BTC. That's where she puts her Bitcoin. And so she gets 3.6% there, as well as Curve BTC that we have seen together. Right. Another more aggressive portfolio here, Bitcoin, ETH, almost half with Eda, who's a farmer. Her risk appetite is definitely more aggressive. Interestingly enough, she has a yield that is a little bit similar. The reason the two yields are actually similar, despite the fact that Eda is taking more risks, is because the yield on ETH and Bitcoin is lower than the yield on stablecoins. And so stablecoins today are paying yield to the conservative portfolios. In this case, Eda is also like looking into across BTC. A lot of people love that pool. But on her ETH, she's putting it mostly on the Yearn ETH market making pool. That one has been paying double-digit yields for the past year, and that has been like really a pool that we identified at Exponential and that very few other people have seen. She also has positions on lending Bitcoin. This is like fully collateralized secured lending, so there is very little risk for the lender. And she's making 4% on there, which is like really, really good. And finally, the best slide for the end. We have created this promo that you can find by taking this QR code here, where you can basically make $100 by investing $1,000. I'm gonna leave it here. and get to the questions. All right.
I think we have a few that are still open. I answered a few ones, but let's start with the ones that are open. And then if you want to add more context to the ones that are answered, that'd be great as well.
Can you read the questions, Oscar? Because I cannot see them.
Yep. First one is from Peter. Will this webinar be available to view again at a later time?
Yes, probably we are going to run this webinar on a monthly basis, and we are going to try to make it available also to people in other regions around the world. So this is particularly a good time for Western Europe and till the West Coast in the US. We should probably do something else for anyone in Eastern Europe or in the Gulf or Singapore.
Awesome. Thank you. Second one is from Max. I'm a UniV3 active farmer. What do you have for me? For example, right now I farm ETH with an average 1,000% APR for the last 3 days, made plus minus 8% during this time.
Yeah, this is great. I mean, I'm really happy for you on the yield there. So typically, we do not make UniV3 available on our platform, and the main reason for that is that there is a design question on how are we going to present that, because the yield on UniV3 has permanent loss in the sense that every time that you're outside of the range and you have to reassess, you end up with like having to change the range, and by doing so, the yield that you see of 1,000% is not comparable to the yield that we show of like, let's say 10%, because you may have impairment loss there. And so these yields are not the same thing. And therefore we haven't cracked the case yet on how to show comparable yields. The yield that you have on exponential is comparable with one-to-one. So that's the part that we're struggling with in terms of bringing in EV3. And so that's why we didn't do it yet. The way we look at this is that there should be yield that is really sustainable over time. And so when we get to concentrated liquidity, the yield is less sustainable in the sense that the range is going to change. And so we don't want people to invest in something that is going to require them to move again after a few weeks. And so once we crack that, we'll be definitely like adding UniV3 and concentrated liquidity pools on the platform. Any other question?
Yep, there's one from Viv. I'm sending you to farming. Will someone be able to set up my first yield for Shiba? Never done it and don't want to mess up.
So meme coins are really like a new asset class that is very, very interesting. Shiba is one of them. The issue with meme coins is that we don't see a lot of sustainable yield in the sense that you would typically, the only way to get yield on Shiba would be to lend it to someone who would be shorting it. And so that's pretty rare in terms of like people shorting meme coins. The other part is a potential job to get on a meme coin is market making with another type of coin. And because SHIB moves so fast in terms of price, it creates impairment loss and impairment loss is something that you can look into in the learn section of Exponential. But basically, as you do market making with two assets, and the two assets keep rebalancing to stay at 50-50 on the pool, you basically lose a little bit of value as there is like this change. And so what we see is that when you have a meme coin, whatever other coin you place next to it, because of the volatility of the price, you would end up with a lot of impermanent loss. And so it's not necessarily a good investment for you to get yield on your meme coin. And therefore, we would love to make meme coins available for trading and investing on Exponential. But our main job right now is to make yield available for you, and yield on top of your crypto, and yield that is sustainable. And that's today not on meme coins, unfortunately. So the main coins that we're looking into are anything related to Bitcoin, Ethereum, and stablecoins, dollars or euro coins. All of them get sustainable yields. And so it's a little bit like being into what makes more sense for yield. Chainlink is actually available. There's a great yield where I'm invested in there, and I'm making about 4 to 6% on Chainlink. And that's one-click invest, which is like really, really cool. So if you on board with the dollars, you can invest directly into the pool to make that 4 to 6% on Chainlink, or Link, actually. And if anyone wants to, we have onboarding experts. Basically, we have people who would sit with you for half an hour to set up your account and allow you to connect your bank account or fund, or go through KYC and all of that. So if you want to book a time, you just go on the website exponential.fi, and instead of instead of looking to grow my crypto, you have a button next to it, which is talk to an expert. And you can book a time and talk to Matt, our onboarding specialist. Any other question, Oscar?
Actually, yes, we've gotten quite a few. This one from Karen and Craig asking something very similar. Karen asking, what security measures do you have in place to protect user funds? And Craig asking, is Exponential a custodial or non-custodial platform? So both about Exponential's fund security practices and what we do there.
Yeah, these are very good questions, especially with what happened to other centralized exchanges and things over the past 3 years. Thank you for that. So Exponential is a custodial solution, in the sense that we take care of the custody of your LP tokens while they are getting yield with us. We are looking at solutions in order to allow you to move your LP tokens out, so that like you can keep them on a secure wallet if you want to. The main issue that we have is a technical issue there, because most of the yield today is on pools that are reward pools. And the amazing part that we do at Exponential is that we auto compound the rewards, in the sense that a pool like the one that you have seen on a cross BTC is going to give you rewards on ACX tokens, which are like rewards from the protocol. And we are going to farm them on a monthly basis. So what that means is that we claim the reward for everyone, we sell them for more Bitcoin, and we auto compound that, so you get more Bitcoins over time. And so that auto compounding cannot be done if you have your own wallet. And so that whole reward management is actually really hard to do in a non-custodial way. And so in order to solve this from a design principle, we build the best custodial system that exists. So Oscar can probably link to a blog post on how safety is done so that you can read it slowly. But basically, the core principles are all your assets, all the assets for all the clients are segregated from company assets. They are not in our balance sheet. All the assets are backed one-to-one and on your name. Nobody inside Exponential or outside is able to move your assets on chain without your permission, without your specific order through the front end of Exponential. When you fund a specific wallet that is yours, and your assets stay there as long as you have funded. Once we are trading on your behalf, once you are telling us to invest in a specific pool, we do it with our own funds, the company funds, in order not to put your funds at risk at any time during the trading cycle. Once we have done the trading, we put your LP tokens on cold storage so that they are as safe as possible, where they cannot be moved by anyone, and where there is no that risk of smart contract anymore. And then only then can we get reimbursed from your wallet that is under joint custody with us. So this is basically the system that is the most secure in the world, I think, for anything related to DeFi. We even have three clouds. One that is related to your front end, where you put the orders. One that is looking into aggregating those orders to bring them on chain. One that is monitoring all the transactions to make sure that everything makes sense. And these three clouds don't even trust each other in order to make sure that everything is precisely being done the way that the users have asked for. We'd love any follow-up for that as well.
Yeah, that's a good summary, Mehdi, into our security practices. I think the main challenge for anyone investing in DeFi is how to stay secure. And so if you're doing it on your own, you have to worry about managing your own keys, operational security, cold storage, hot wallets, cold wallets, and all of that. It's a full-time job to handle your own keys as well. I think the last question is from Divyanash, and sorry if I'm butchering your name. Question is, because of the Stark reward program and looping stables on Nostra and CK Lend, the yields are on the higher side. Why not list such strategies based on yield, not added on Exponential?
You want to take that question?
Yeah. Yeah, I mean, we're always looking for new pools to add. CK Lend and Nostra have not been on our radar because the amount of liquidity available was too low. So yeah, I mean, we're happy to list any pool as long as it passes our risk assessment, and also that the yield is worth the risk. A lot of the times we don't list new pools because the yield, let's say, is 5%, and the risk is a C or a D, and so the risk reward is simply not there. We want to have the best yields for the lowest level of risk available in Exponential. But to the question, can we list Nostra and CK Lend pools? Yep, we can, as long as they have interesting yields and the risk is corresponding to that level of reward. Yep. Viv asking if he could be affiliate. Yep, I can reach out to you after this webinar. and have a conversation about that. Awesome. I think that covers it. It's been great. Thanks everyone for joining and tuning up at this time of the day. Mehdi, thanks a lot for the webinar. Yeah, we'll have a recording after this, and we'll share it either tomorrow or next week. But yeah, thanks everyone.
Thanks, Oscar,
Thank you,
for
Mehdi.
setting it up, and thank you everyone for joining. It was great.
Thank you. Bye.